Well, thanks, Greg. Hello, everyone. Welcome to today's webinar. We're really excited to have you all here with us today. We have one of our newest and greatest partners with us today, Ray. He's going to be talking about how stock traders can calculate and maintain relative position sizes with risk control strategies. Before we kind of jump too far into things, I'm just going to go through our quick legal disclaimer here. So today's demonstration, it's designed to instruct you on using Metastock and the accompanying software plugins, and is not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. And now that we've got that out of the way, I'm glad to be introducing Ray. We've had him speaking for us several times now. He always does a fantastic job. You can see kind of his list of experience here, and I know that he can read it off better than I can. So I'm actually just going to kind of let him take the reins and kind of guide you through today's presentation. Hi, Ray. How are you doing?
Good. How's it going, Bobby?
Hey, it's going well here. Thanks again for agreeing to come on today and do another presentation for us. We're always really excited when we're able to get you in and have you kind of go through this with us. I'm going to go ahead and make you the presenter here. So you should get a pop-up here in just a moment.
Okay.
Right.
Are we good? Not so much, huh?
All right. Yeah. So I'm going to go ahead and get out of your hair, but I'll be here if you need help with anything in the background. So yeah, thanks again. It's all you.
Okay, Bobby. So we have the slides up. Is that correct? We're good?
Yes, correct. We can see the main slide there.
Good enough. Thank you. All right. Well, here we go again. I think this is my fourth one, maybe in about 6 weeks. It's a lot. Welcome to today's presentation. And again, of course, I want to thank you for attending and Bobby for his introduction. This presentation has 3 sections, about 35 minutes of formal material. In section 1, we're going to look at risk and volatility and set the stage for what ProV can do for us. In section 2, we'll show how to run and use ProV to set proper position sizes. In section 3, we'll look at some hedging approaches and how ProV can generate the statistics to use them effectively. Included in this section will be a way to hedge your portfolio and in a way get paid to get the insurance to do so, which is kind of a unique twist. Also, I should add here, because it comes up, that ProV can be used with mutual funds, and we're also going to show how to do that. Before we start, a little bit of housework. You know it's coming. It's always there. This screen basically states, don't steal our stuff or else. The next screen kind of tells you all the reasons why the material in this presentation may not be 100% accurate, that there's exceptions to every rule, and why the material may not be suitable for all investors. Not real uplifting, is it? Lastly, this one is not even from us, but we need to include it. So if you have questions, I hope not at least on this material, or anything else in the presentation, I hope you do there, please write them into the chat, and Bobby may answer them as we go along, or I will address them at the end. I'm going to continue the flow of this presentation. Even with these questions, because some of these areas may be new to you, and some of them will be, please keep in mind that AAII supplies full educational classes on many investment topics, including conviction and ProV. And as an attendee today, I believe that everyone is going to get a free class on active investment management. This class is taught by the National Association of Active Investment Managers. And on the screen, you can see what a typical class entails: studio grade, screencasted presentation, additional resources, slides, tools, testing, credits, certifications, and extra benefits for those who pass. So it's free, why not take it? With the classes, I do want to point out that you'll also get an AAII ProV instruction guide. And this is in addition to the Metastock version or their instruction guide. These guides cover how to set up the indicators, how the indicators are calculated, how to interpret them, their pros and cons, where they work well and where they don't, and how to adjust the parameters if you're an advanced investor. As promoted, we're going to look at a tool that we developed today. It's called ProV. And ProV is an acronym, and it stands for a position ratio optimizing volatility engine. And here we're going to lay the foundational knowledge to use the tool. As listed in the promotion, ProV was primarily designed to answer two common questions. How many shares should I purchase? And how many shares should I rebalance to offset price and volatility changes since my initial purchase or opening of the position? And ProV also assists investors with the third entry on how to deal with risk from a macro perspective. This will become more clear as we go through this presentation. In this presentation, we're going to cover several ways to deal with risk. So even if you choose not to use ProV, the content in this presentation can be beneficial for other trading or investing approaches. And in the end, we're going to look how to use risk as an opportunity and possibly a way to increase returns with the methods, or at least one method, that you've probably never seen before or even considered. Where we're going to look to protect the stock portfolio, and we're going to look to get paid to protect it. So what is risk? There are many different definitions and ways to define and interpret risk. And in this slide, we have a few of them. Uncertainty with respect to an investment, potential financial losses with an investment, the probability of loss with respect to an investment. Real risk, some would say, is the likelihood of not having enough assets when you need them. And then finally, our last one, the difference between the anticipated losses and those that are realized. And I would say that the last listing is probably the most accurate definition for at least the most useful for knowledgeable investors like people in these webinars who are learning about investing. As now something's happening that's extreme and that we hadn't anticipated or accounted for, even with all our measurables. So even if we go with a simple definition of risk, we'll say the chance that an investment will lose value, there's still a gray area on how we measure it. Are we referencing and measuring nominal or real after inflation returns and risk? Do we factor in currency conversions and or tax ramifications? These are all legitimate areas of risk, and in totality, they can be hard to account for. And that is what ProV has been designed to assist investors with, addressing it from both a security systemic level and a macro or systematic risk perspective. And this is covered in section 3. But to start, we're going to look at securities in isolation or individual security risk. And here you can see some of these types of risk here. Not concentration risk, more so, concentration risk of an industry or a sector, but on a per security basis. And the reasoning here is sound. If we keep the individual security sizes low and proportional, it theoretically buffers from a portfolio perspective all these types of risk from having a major negative effect on a portfolio. So if something goes wrong, we're not overly concentrated on one particular security. We live to fight another day. In other words, our goal is to prevent any one issue from becoming overly dominant or risk-heavy, skewing the median stock position or portfolio's overall performance. As we don't want one or two positions to dominate the overall performance of a stock portfolio. We want to keep the individual security risk in control, or at least relative to all the stocks that make up the portfolio. And for this, we're going to use ProV. So ProV's most basic function, it does a lot more, but its most basic function is to calculate position sizes, the number of shares to buy or rebalance, so that each position will have a projected similar end effect on portfolio performance. And we don't do this by buying equal dollar amounts of each security, as we will see. Now, stepping back, position size is often a confusing area to newer investors. Some investors, not many, but there's still a few left, try the equal share approach. In this slide, we can see with that approach in the Dow 30 components that if an investor purchased an equal share amount of, say, 100 shares of each Dow component at this time the explanation was generated, their position sizes would have ranged from $2,892 of Intel to over $49,000 of United Health. This is certainly not a balanced or equal distribution. And some investors, even today, mostly the old timers who remember teenies, will not only use equal share amounts, but they try to purchase them in round lots or in 100 share increments, leading us to a couple of very basic guidelines that will tie in with ProV later. And most of you already know these. Number one, if possible, initiate and rebalance position sizes to the calculated number of shares that you really need. Number two, don't gravitate to round outdated round lot methods. It's not required anymore. And three, if possible and appropriate on high-priced issues, consider using fractional shares. And ProV has been designed for fractional share functionality if your platform supports them. So equal share approach to position sizes, no. Equal round lot approach to position sizes, God, no. The next level investor seems to gravitate to a different approach when it comes to position sizing. Anyone? I'm sure you probably know where I'm going with this. The equal dollar approach. And certainly that's better, but it's missing one key element. What are we missing? Most of you will know this. Volatility. How much the issue typically moves. Do we really want to purchase the same dollar amount of a security that is 3 times as volatile as another? Or that moves 2% a day as compared to an issue that moves 6% a day? Probably not. When we're charting the volatility, it's reflective in the pattern size. They're fractal. So that guides our actions naturally. But for position sizing, there's no visual reference frame, so we need to do it numerically. What is volatility? Again, many different definitions, but volatility is a mathematical approximation of the measurement of risk, a statistical measurement of asset price fluctuations. And even in the complex field of financial engineering, measuring risk by no means, unfortunately, is an exact science. And there are many ways to measure risk. We're going to look at a couple of the common ones in the next few slides, but keep in mind, interestingly, ProV doesn't use any of these methods. Beta. Think of beta as the tendency of a security's returns to respond to swings in the market. It incorporates both volatility and correlations of returns between the security and the market. A beta of less than 1 means the security be less volatile than the market. A beta of greater than 1 indicates that the security's price will be more volatile than the market. For example, if a stock's beta is 1.2, it's theoretically 20% more volatile than the market or the benchmark that it's correlated to. Higher the relative beta, the more volatile to the benchmark it's being measured to. Standard deviation, very valuable, especially with indicators. In fact, we use it in the kinetic conviction indicator if you watch some of the previous webinars. It is somewhat complex to calculate. It has different calculation variations, and unfortunately, it can be somewhat difficult to find for stocks, although interestingly, very easy to find for mutual funds. Standard deviation definition, a statistical measure of dispersion around a central tendency or a mean. How often is something like that likely to happen at a certain level? Again, a higher standard deviation value is interpreted as higher relative volatility. Last one, we'll look at average true range or ATR. And this is typically the range of a bar plus any gapping. ATR measures volatility, and there's variations of the measurements. We often use exponential moving averages of ATR because we want to emphasize more recent activity. And we always use ATR percentages for securities, for security to security analysis. We don't want to use ATR dollars. That leaves the price level skewing, even within an own issue on large price swings. ATR is simple to calculate and understand. It's used in many indicators and by many traders and investors for stop loss calculations and profit targets. Again, in fact, ATR is used in the conviction systems as one criteria for profit targets and stop losses. It's not the only criteria, but is one fail-safe entry. The key point here is that all of these volatility calculation methods have strengths and weaknesses, and it's best to match the calculation method with the application. That's Volatility 101. And now we can look at why factoring in volatility for maintaining share size to control risk is so important. Without it, the investor using the equal dollar amount approach, let's say in a fixed $10,000 amount of the Dow 30 components, as you can see right here, would have experienced a maximum 5-day loss of $595 over the last year on Johnson & Johnson, a very stable company, but would have incurred a $2,126 maximum 5-day loss over the last year and Intel. Equal share, no. Equal Dow is better, but we obviously need to consider volatility because the dispersions are too great and too varied. How does ProV approach this? ProV factors in the volatility, but in a different manner than the traditional volatility approaches that we just covered. ProV measures and uses downside volatility only. More accurately, it outputs the percentage loss of an issue on an average down day as measured over a specific time period. Not range, which is more useful for stops and targets, not standard deviations, which is certainly more useful for indicators, and not beta, which is more useful for mutual funds, although standard deviation is effective there also. We use average downside loss volatility for this specific application, the percentage loss on an average down day. And this method was chosen for a few reasons. And again, we have our humor slide here. It's very rare, first of all, that an investor comes up to me and tells me that they can't stand the magnitude of the upward moves, that they're making money too fast, that they need me to adjust the systems and temper down the gains. The rates are just too quick. We don't hear that. We know that downside volatility is generally greater than upside volatility. So why use symmetrical measurements like standard deviation? And we also know that good investors and traders focus on the risk and they let the profits take care of themselves. So we want to focus on the downside. Markets move up and down differently because of greed and fear and other variations. So why not use that to our advantage with system design? It takes a little more effort, but it's usually worth it, as we will now see. That's a little theory and reasoning on risk and volatility. It's probably just a review. I'm assuming most of you knew this. But in this section, we're going to cover the elements of ProV and how to use it for stocks and mutual funds to reduce risk. Let's look at how to begin an exploration with ProV within Metastock. After logging into Metastock, you would click on the Power Console. From the Exploration tab, you would select AAII ProV Share Calculator, and then you would go down and select the securities that you want to analyze. We chose the Dow 30 here. After that, you click Start Exploration. In a few seconds, the program will generate and display all of the outputs for all of the securities. Here's an enlarged version of the outputs, and we'll define each column. Then we'll show you how to use the information. It's very straightforward. Column 1 is obviously just the name of the security. Column 2 is a little confusing. It shows you the desired or benchmark amount of risk that you are generating the number of shares for. This value is the amount of loss at the specified number of shares on an average down day for the security. This amount can and should be adjusted by each user according to their risk tolerance. And we're going to cover what value to target for this number and how to adjust it in a couple of slides. But this value is the theoretical amount you should lose on an average down day for each security. And you set that value to your own circumstances. And we want this value to be the same for all the securities, obviously. Column 3 shows the number of whole shares that you would purchase so that in an average down day, the issue would lose approximately $50 in this case. And this is based on the security's price and historical volatility of the issue to date. This amount is dynamic and will change as the price of the security rises and falls, and the volatility either increases or decreases. This is the key output value. How many shares should I buy or rebalance to? Column 4 shows how much the position would cost to initiate at the listed number of shares. This dollar value is simply the number of shares recommended by ProV times the last price. Remember, all these values are covered in detail in the AAII ProV instruction manual, which everyone's going to receive. So if you're not getting all this, it's fine. Column 5 shows the dollar change or loss that should occur at the specified number of shares on an average down day. Wait a minute, Ray. You said it was going to be $50. Well, it's not 50. Why? Because we're rounding down to the whole share amount. If you set ProV to display fractional shares, which I'll show you how to do again in a few slides, then this number would be exactly 50. But because we use the whole number, we're showing a reduced amount, even in cents. Column 6 displays the average down day percentage amount that ProV is calculated based on its methodology. This value can be used for relative volatility comparisons between securities or for a general frame of reference. How much does it lose on an average down day? Jumping to column 8, we have the opposite of column 6, and this shows the average up day percentage amount that ProV is calculated. Column 7 displays an up-down ratio of the up percentage amount divided by the down percentage amount. Values over 100 indicate that the average up percentage change is greater than the average down percentage change, and values below 100 indicate that the average down percentage change is greater than the average up percentage change. We're just giving you more information about each security. Finally, we have some more reference information. In column 9 right here, we show the percentage of time that the issue finished down over the measured period from the previous close. Here we can see that 3M finished down 54% of the time. In column 10, we show the percentage of time that the issue finished up. Yes, that's right. At column 10, we show the percentage of the time that the issue finished up over the measured period from the previous close. Here we can 3M finished up 45% of the time. And column 11 shows how often there was no change. And believe it or not, it does happen. So in this area, we're just showing if the security finishes high or low the majority of time. And in the previous columns, we're showing by how much or how on average, how much. Area 12 displays some general last price, volume, and symbol information. Now, before we get into how to set and adjust the amount of risk in some of the more advanced hedging applications that ProV can be used for, we're going to focus on the primary application that most investors are going to use for ProV, at least at first, setting new positions. I want to buy security XYZ. How many shares should I buy? Once the risk amount has been entered, the default value is 50, as you can see right here. Whenever an investor wants to initiate a new position so that it has a similar risk profile to all their other positions in the portfolio, they would bring up the ProV Explorer. In the Explorer, they can either scroll down a broad index of issues like the S&P 500 and find their stock in a list, or they can enter the stock into a newer custom list and ProV would generate the number of shares and the dollar cost of those shares at the current price. You should buy XX number of shares as displayed in column 3 at a cost in column 4 to keep it balanced with the rest of the positions in your portfolio. The second most common application is for position monitoring and rebalancing. As time goes on, the price and volatility of an issue is going to change. And it's only logical for an investor to adjust their position sizes to reflect these changes and rebalance their portfolio. The logic is straightforward. If a current stock position's number of shares are much greater than what ProV is calculating, then the investor may want to consider reducing that position size. This would happen if a stock's position increased in value and or volatility. There's more relative risk. We want to reduce it. If a current stock position shares are much lower than what ProV is calculating, then the investor may want to consider either increasing that position size or reducing the other stock's position sizes to bring them back into relative proportion. This would happen if a stock decreased in value or had a reduction in volatility. And again, this is all covered in depth in the instruction guide as I was showing. Here's a hypothetical example. On the top, we're showing the initially recommended and assumed current position sizes of 3 securities in a portfolio. We have 3M, American Express, and Amgen. And this is what it was when we initially set it. Under that, we are showing some new hypothetical position sizes that are reflective of recent price and volatility changes. We'll say that these were generated a month later. In this case, the investor would add 5 shares to their current 35 share holding of 3M to bring it up to the 40 shares, the new recommended amount. And they would sell 3 shares of American Express to bring the current number of shares to 20 to bring the positions back into relative balance to each other. Fairly straightforward. And as promised, ProV works with mutual funds. In this explanation, we have a Vanguard small cap, large cap, and mid cap fund. And what do you notice in the position size column? The red arrow. Small caps are more volatile, so we would be purchasing less of them, about $23,000. Mid caps would be the second most volatile, as ProV shows us. And here we would purchase around $26,000, the yellow arrow. Large cap, the most stable group, would purchase the most at around $31,000 worth. And it gives you the amount of the shares at the current prices. This is exactly what we would expect to see, but the amounts are refined for us. We're not guessing without any method or some types of evidence. And we can enter in here 40, 50, or 60. We can enter up to 1,000 mutual fund symbols, and we can check to see if our portfolios, our mutual fund portion of our portfolios are balanced. And we can even mix mutual funds with stocks, so again, with the same goal. As mentioned, there are a few settings that can be adjusted with ProV. In this video, you can see how this is accomplished. First, we go to the indicator builder and select AI ProV share calculator settings, and then we click edit. In the indicator edit box, you can adjust one of 3 settings. At the very bottom, you can set ProV to calculate and display fractional or whole share values. One level up from that, you can adjust the number of days that ProV is evaluating to generate its statistics. The default setting is to 1 year. But if you're position trading or targeting holding periods of saying 2 weeks to maybe 12 weeks, you could drop it down to 120. That would seem reasonable. It would be more responsive to what's going on now. And at the top is where you would set the most important value. That is your average down day target risk, which we're going to address now. There are a few approaches for arriving at the correct amount for your circumstances. Many traders and investors just use intuition and adjust the target loss amount up and down, as I just showed you, from the default value of 50 until they see share sizes that they know that they are comfortable with and they often take. Another method is to use the average down day loss value from an established position that an investor is already familiar with, like a benchmark, and then enter that amount into ProV. For example, let's say that an investor owns 100 shares of the ETF DIA, the Dow 30, and they're comfortable with that daily average risk amount. They've been following it for years. Here, the investor would enter DIA into the Explorer, and they would see at the default value of $50 of risk, that would equate to 19 shares. Well, they have 100 shares, and they're comfortable with that risk amount. So they would increase the target risk amount about 5 times to bring that up to 100 shares. 5 times 50 gives them their $250 targeted risk amount. To be exact, they can divide 100 shares, which they're comfortable with, by the 19 value, which ProV is showing. You get the number 5.2. 5.2 times 50. The investor knows that they want to target about $260 worth of daily average downside risk. This video here shows the entire process. First, you can see the default setting of 50, right here, at 19 shares of ETF DIA. And then you go back into the indicator like we showed a few slides ago, click edit, and you would change the value simply to $260 per day. You would close the editor, then you would run the Explorer again, and you can see ProV now recommending 99 shares of DI at the new risk level. Again, it's rounding down to whole shares. This is what you just calibrated. ProV settings are now set going forward. And here for reference, after running the Explorer one more time on any stocks you would like, you can see your new risk values. You can see that the calibrated share amounts and cost of each of the Dow 30 components, all of these are now being equal to the historical risk profile of the 100 shares of Diamond that you said you were comfortable with from your experience. At these share levels, every issue should theoretically lose $260 on an average down day of each security. Of course, this is theoretical. We did this quickly, but it's very simple to do, and we actually provide 3 methods to evaluate this value in the instruction manual. But once this value is determined, until your circumstances change or you want to add or reduce your risk level, you can use ProV for both establishing new positions and periodically checking the values to see if a stock's volatility or price changes warrant any adjustments. Few remaining items on this, few tips or hints. The best way to use ProV is to keep a custom list of securities, at least for monitoring adjustments. As the market goes up, your dollar values of your positions will go up, so you may want to tweak your risk target amounts higher, or you may just want to take more positions, but keep this in mind. These numbers will go up and down, obviously, as the values of your positions changes, and that's dependent on how the stock market's doing. These values are dynamic, so for keeping stock and mutual fund positions relative, I would not fine-tune small changes. These guidelines are up to each investor, but I would say that running the scan every maybe 2 to 4 weeks for stock positions, maybe more frequent, and every 1 to 3 months for mutual fund positions would probably be enough for most investors. But again, it's up to you. And after a scan, I wouldn't look to tweak discrepancies less than 10 or 15% from your current share amount to the calculated values. Yeah, I ran it once a month and it's only 5% off. It's only 3% off. That's probably not enough to go in for this particular application. Now, if you're looking to hedge, which is coming up in the next section, then you might want to do finer tuning. Those are proof-based calculations and primaries functions, providing relative position sizes to initiate and maintain rebalancing so that each security will have a theoretical equal effect on the portfolio's performance. And for some investors, this may be enough to balance systemic or individual security risk. But for other investors, ProV statistics can be used to cover overall market risk, which is the most dangerous type of risk to a portfolio. And we're going to cover this in our last section. Up to now, we've looked at some theory and one approach to controlling systemic risk at a security level, primarily through controlling position sizes. So if a single security goes bad, we're hopefully okay. But what if they all go bad? That's the real concern. Macro risk, we're going to look at this. This risk tends to be inherent to the entire market. When these types of risks occur, it seems like everything goes bad pretty much at the same time. And here we can see some of those types of risks. And these are very real risks, and we've probably all lived through them at various times. Now, we can try and reason that the astute investor may see some of these coming and that they may be able to get out of the way before the masses and before the major damage is done to your portfolio. And I agree, especially for those using charting techniques, as contagion does have a delay factor. But I think even the most optimistic of investors would agree that there are some types of shock-related risks that can't be front-run or predicted in time to prevent significant financial losses. Again, listed here are some of these types of shock-related risks. And although diversification certainly has its place, a little bit more on that in a minute, correlation statistics show that 85% or more of a security's moving can be now attributed to the overall market direction. And there are many reasons for this, and that list seems to keep growing as time goes on. Correlation among issues in different asset classes seems to be growing. So anyone who lived through the Great Recession can attest that there were not many places to hide, and this phenomena does exist. I mean, U.S. Treasury yields went negative for a time. So to counter this, or at least deal with this type of risk, we're going to look at some popular hedging approaches. And then at the end, we'll look at a non-conventional but interesting approach that I referenced to in the beginning of this presentation. For traders, we're going to look at shorting and equity market neutral approaches. For investors, we'll look at some longer-term oriented approaches, including derivatives. And I should say that we're just going to cover the basics of these, okay, to serve as an introduction and to show how you would incorporate ProV and how you would utilize it with each approach. This is important. We're not looking to cover any of these hedging approaches in enough detail for someone to go out and utilize this if they've never used these approaches before. Equity market neutral. EMN is a hedging strategy that looks to offset directional market exposure risk by taking both long and short positions, with the position sizes adjusted for volatility. To see what an example of an equity market neutral approach might look like in ProV, to keep things simple on this screen, we only have 6 securities. In this example, because the expected average downside loss is projected to be the same among all 6 issues, one could simply purchase or go long the recommended amount of 3 of the issues, the recommended share amount of 3 of the issues, and short the recommended number of shares of 3 other issues. With this approach, we're looking to generate alpha with our returns being dependent on the long positions making more than the short positions, or the short positions losing more than the long positions. One thing to keep in mind with this approach is that it should theoretically track better with higher correlated offsetting issues in similar industries. If you're new to this approach, you can research statistical arbitrage. A classic example of this would be buying Coca-Cola and shorting Pepsi with volatility adjusted amounts, not equal dollar, again, where ProV comes in. Now, this is a simple example, but it illustrates the base concepts and how you would use ProV's calculated share amounts to address this type of approach. A similar approach to this is where an investor is confident that they can pick stocks that can consistently beat the market or an index. Here, an investor would take all long individual stock positions and then short the index that they are most correlated to, effectively creating a volatility-adjusted hedge or market neutral portfolio. If the market goes down, the short index position gains should offset the individual security losses. You make money. If the market goes up, the individual security gains should be larger than the short index position losses. You make money. Performance comes down to you or your stock picking ability. Now, one critical point here is that the short index ETF, as we see right here in red, has to be multiplied by the number of securities that are being held. Think about this. In a perfect world, if the market had an average down day, these 6 individual securities would each lose $260 for a total loss of $1,560 for the day. To offset this, you would need to short 600 shares of the market, or the Dow ETF DIA, because at the shown 100 share level being displayed, this is only going to gain theoretically $260. So you need to multiply the number of index shares times the number of positions on the other side. If this seems confusing, just step back, think about it, and read the manual, and it'll become crystal clear why you need to do this. A couple of things to keep in mind on this. You will almost certainly underperform the market with this approach when the market's going up, no matter how skilled you are as a stock picker. But you should outperform the market when it's going down, unless you are really a really bad stock picker. For this reason, some investors only hedge in times of anticipated short-term market uncertainty and or when they don't want to liquidate their positions and generate tax consequences. In this scenario, this can be very effective strategy. Geez, I don't like what's happening right now. I don't want to liquidate all my positions. Let me put on a quick hedge. How many shares do I need to hedge it? And then let me see what happens when I feel a little more comfortable. Other considerations on this type of approach is that short debit fees will negatively affect performance. So this would favor using the index version, where major index ETFs like the Diamonds, SPY, or the Qs would be preferred hedges because they're easy to borrow and should not entail high fees, or in most cases, really any fees to initiate or maintain the hedge other than tracking errors, which are minimal. Now, this is a critical slide for 2 reasons. First, it highlights an important investment concept. On this screen, you see all 30 Dow components plus the Dow 30 Index ETF DIA. The list has been sorted from the least volatile issues in the top to the most volatile issues in the bottom. The blue highlighted section shows that DIA is the second least volatile position in this list, with an average down day of only 0.73%, less than 0.75%. Now I ask you, how can this be? Would we not assume that the average volatility of all the index would be somewhere in here? How can the index average volatility be at such an extreme low with only Johnson & Johnson being less volatile? It should represent the average. You should know this answer. This is a classic example of diversification, where the individual correlated components have more risk or volatility than the weighted average of its constituents, or the index. You can see the advantage of diversification in the numbers by diversifying out. Our second point here, this is a prime example of the importance of including volatility with hedging approaches. For someone using a dollar approach, I have $25,000 worth of long positions and I'm concerned about the market. So I'm going to take an inverse position to neutralize the risk and short $25,000 worth by some method. With this approach, they would likely not have enough hedge of the index position because its movements would be less than what would be expected due to the diversification effect. It won't be as responsive. Does this make sense? This is why we want to include volatility into our calculations. Now, I know what you're thinking. For investors that do not feel comfortable shorting or can't short securities because of the type of account that the securities are being held in, they could consider using one of the inverse index ETFs, where an investor can create a synthetic short position while still having a conventional buy, long, sell structure. This seemed reasonable for short-term hedges, but as one can see in the above diagram, the volatility right here of the ProShare Short Dow 30 does not correlate exactly with the inverse ETF. It doesn't parallel. It's still a little bit more volatile. The volatility is greater, and this is due to a variety of factors, which kind of goes beyond the scope of this presentation, but these anomalies can be exploited by more advanced investors. The bottom line is the proof can be used to calculate the share and dollar amounts on a variety of security types for a variety of approaches to hedge risk in a portfolio. You just have to match it with your preferred approach. Last 5 slides become a little more complicated here. Here we're going to look at how to use proof to hedge risk with derivatives, in this case, put options. And if you're not familiar with options, just think of a put option as a security that you can purchase to protect your portfolio from losses. You buy them and sell them on an exchange, and they have bid and ask prices just like stocks. They are very similar to the way that you insure your home. The more insurance you want and the longer the time of protection, the more it will cost you. And to get that protection, you have to pay a premium for the insurance. Or do you? Using puts with major indexes has a number of benefits that you can see here. Small capital expenditures, they're easy to adjust and fine tune. They cover various time periods, very tight strike prices, high liquidity. You can do intraday executions and adjustments, and there's little extreme strike risk. So using this approach does have some advantages. Going back to our previous example, by trying to use a put and incorporating this technique with proof provides us the value of 600 shares of DIA to short. Here we would use that target amount to purchase puts equal to that amount to generate the required protection. But to do that, you have to know how many puts and what puts to purchase. And to do that, you have to use the options delta. The relationship here is that the option delta equates to the number of shares that it would act like, or the underlying would act like. And the formula is shown. If you're using extreme in-the-money options with a delta near -1, then 6 contracts would give you the 600 shares worth of protection. But if you're using an at-the-money option of -0.5, you would then need 12 contracts. -0.5 would equal about 50 shares per contract. You need 600 shares, so you would need 12 contracts. This is a basic example of a delta neutral approach, a very common approach, and some would say it's why implied volatility levels are being driven so low in the markets. The negative of this is that the insurance of the hedge will cost you money, just like when you insure your home. The more insurance you want and the longer the time frame, again, the more it will cost you. For a frame of reference, here is a past example showing the average cost for 30 days of protection at a somewhat regularly seen 20 VIX level, at about 1.6% for 30 days of protection from the current price. That seems about average, at least at a VIX of 20. To put this cost in perspective, at an extremely high VIX level of 80, the average insurance cost for 30 days of protection was 8.5%. That's a lot. With this information, we have a few suggestions for hedging with long puts. One, consider holding long puts for short, strategically timed durations. You can't make money holding them constantly and have someone else take all the risk. Number 2, open put positions when relative implied volatility of levels are low. You want to target buying insurance when it's relatively cheap. And the third consideration is consider closing put options early in its life cycle, as theta is exponential, it's not linear. the extrinsic value of your options lose money faster the closer you get to expiration. Time decay, again, is not linear, it's exponential, and the formula to calculate that is shown at the bottom right here. Lastly, consider option spreads. This is for advanced investors, and this was the tease. I'm going to stay on this screen for a minute. Here we have two option approaches, and these were taken from real-time data, okay? The first, they both give us $1,000 worth of protection, as we can see right here in the delta dollar column. The top position is a long put position, and for a dollar move down in the S&P 500 or the ETF SPY, you would make about $1,000 of protection. You can see it right here. It's listed as $997. The problem with the long put position is that it's going to cost you about $15.63 a day, as displayed in the position theta column. With the bottom vertical call spread, the second option position is a spread, and you can see we're going to get the same amount of protection right here, about $996 on a $1 move. But with the vertical call spread, again, for a $1 move down in the ETF SPY, you would still have the $996 hedge, but if instead of paying $15.63 a day for the protection, you would be collecting $10.47 a day. Here, instead of buying protection, you are selling another investor the opportunity to profit from an upward move. It's the exact same protection at this time, at this particular time, to hedge your portfolio, but instead of paying for it, in an odd way, you're getting paid to put it on. Last slide on this. Options can be complex, and although both of the positions in the last example have the same protection characteristics at that time, they're going to behave very differently as price move and times progresses. So you have to be experienced, and you have to know how to adjust the positions. Still, the approach has merit if you want to learn how to do it. And again, if you're an advanced options trader, this opens up a slew of possibilities to gain a further advantage and a further edge. You can start using calendar techniques, again, to exploit the decay deficiencies. You can gamma scalp the moves back and forth. It really opens up a lot of possibilities. Final slide. There are many approaches for attempting to control risk, and there's no single universal best way to do it, with the best approach being dependent on several factors and each individual investor's own abilities and preferences. The only universal truth here is that risk is a primary factor that needs to be considered and emphasized to be a successful investor. And for those considerations, the measuring and gauging of the degree of risk by the appropriate means is necessary. ProV is a tool that provides one way of measuring risk and providing guidances, and those values can be used in a variety of ways, from simple share size proportions to advanced hedging calculations, and really everything in between. How you decide to use it is up to you. For more information, you can contact me directly for anything related to ProV or the conviction tools. And I guess I should add in that ProV can also be purchased as part of the Conviction Plus package, or it can be purchased in isolation. My contact information is listed here, and I believe that is about it. My sincere hope is that you learned something here in this presentation that you can use to improve your trading or investment trends, regardless if you use ProV or not. For more information on AAII membership, the tools, the classes, or anything else, you can contact AAII. I'm a developer, I'm a system designer, and I'm a trader. I'll leave the commerce and distribution aspects to the professionals. I thank you for your time. I thank Jeff, who's not here with us today. I thank Kelly, the president, who's not here with us today, the Metastock programmers who have helped me through this ordeal, and the entire Metastock staff for this opportunity. Thank you so much.
Hey, thank you, Ray. Great work, great presentation as always. We're always happy to have you on and go through that. I always feel like I learn a lot every time I watch one of your presentations. So thanks again.
Do we have any questions, or do we just not too much? It was a little too confusing.
I was following along quite well. I'm hoping a lot of our viewers were feeling the same way about it. It doesn't look like we really have any questions that were outside of the norm, outside of just some,
Okay.
General chatter throughout, but no standing questions afterwards. So I think you did a great job explaining.
We'll go with that. Thank you.
Yeah, of course. So let's see. I'll go ahead and take over the screen share here because I do actually have just a couple of slides I want to show with you guys, especially for our Metastock customers that are kind of interested, in getting the tools put into their account. So let me just move this screen aside here. All right. So yeah, we have been working with Ray in order to get the AAII ProV calculator into Metastock, and this is now available. You've kind of seen him using it throughout today's presentation. I mean, in some of like the key inputs here, utilizing the ProV calculator in our Explorer, you can identify how many shares should you purchase, how should you rebalance your positions, and how can you hedge your risk. I know Ray's kind of touched on most of this, but just to go over it one more time, I mean, you're looking at the proportioned risk calculator dollar amount and the number of shares for initiating your new positions. You're going to get these adjusted dollar amounts and the share amounts for rebalancing those. You get statistics that can be used for controlling that risk, including your equity market and delta neutral approaches. The dollar and share amounts for both whole shares and the fractional shares. We'll have up day, down day ratios to see if a security typically gains or loses more in an average up versus down day or environment. Statistics on how often an issue finishes up or down for the day. So all of this is really useful stuff. You can also adjust the parameters within here and kind of control and contour the tools to meet your overall style and meet the functionality that you're looking to get out of it. And with all of that, we're going to set this at a price point of $197 as a one-time cost, but as kind of our release promotion here, and as a special webinar offer, we're going to let you guys pick that tool up for just $127. So I'd say it's one of the most unique and quite useful tools that we offer here at Metastock. And at that price, $127 is a one-time cost. You really can't beat it. You're also going to get a one-year membership to AAII with the purchase of that as well. Or, of course, as Ray also mentioned, if you guys wanted to acquire their full add-on and system, that'll include the ProV calculator as well. And if you have any additional questions about ProV, the calculator, or our other system, the complete system with AAII, we have an entire sales team here that's ready to answer all of your questions, kind of go through scenarios with you if need be, and help you to order that. So you can chat live with them right now at metastock.com/sales chat, and they'll be happy to help you. We also are available on the phone. You can call toll free at 800-882-3040, and we're happy to take your phone call and help you out. Or we also have a landing page put together as well for this ProV calculator, and you can find that at metastock.com/AAII ProV, and you'll have a little bit more information there about the system, and it'll allow you to order online. Just to kind of show you guys what that looks like, I have the web page pulled up here. So you can actually come back and you'll find the recording of the video here as well in case you wanted to watch it as again. You can also find it on our YouTube channel, youtube.com/Metastock, and it'll be the top video until the next release, but you can always search our YouTube channel to see some of our past webinars that we've done with Ray as well. Or like I said, you can, from this landing page, order the ProV calculator. And if you don't have Metastock, we'll go ahead and give you a free trial of that as well to utilize along with the calculator. So definitely something I would recommend checking out. And again, if you have any questions or you need anything, we're happy to answer all of those questions for your specific scenarios. Feel free to jump into our chat room, metastock.com/sales chat, and we can help you out with that. I do want to say thank you one more time to everyone for joining us, for spending, about an hour with us today. And I also want to say thanks again to you, Ray. You once again did great, and we're always happy to have you on. We hope to have you on again soon.
Great. Thank you so much.
Okay, great. Well, thanks everyone. And we hope to see you all again soon as well. Have a great rest of your night.
Hi, Kelly Clement here from Metastock. Before you go, I have two quick things for you. One, thanks for joining us today. We love having you here at our webinars and viewing our videos. So what I'd like to invite you to do before you go is like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. The second thing is we have a great ebook on trading that you can get for free. If you go to metastock.com/YouTube book, you can get a free copy of The Secrets of Successful Traders. It's a great book with lots of content from traders just like yourself who can teach you some of the secrets that they have learned. Thanks for taking a second with me and learning about those two things. Thanks for joining us, and keep on trading.